Hey everyone, welcome back to AWM Insights. I'm Brandon and I get to come in as a guest today and really mess things up. Justin's on vacation, but I get the privilege of sitting down with Mena, as you guys hear from week in and week out. He is the portfolio manager here at AWM, really bringing the knowledge to you guys on a week-to-week basis. And then throughout the week, making sure that your guys' portfolios are well taken care of. Little known fact, Mena is actually the athlete of the office. So he's not only the brains behind the operation, but he's quite the athlete himself. So with that introduction, I would love to just jump in today, Mena. Today's going to be a rapid fire, real talk. Really, what do our clients need to know? Really to be a professional when it comes to the markets. And these are a collection of questions that we've gotten from you guys throughout the week. And at the end of the episode, we'll also give you a way for you to reach out directly to Mena and ask him some of these questions so we can continue to bring you guys the answers that we hear.
All right, yeah, let's kick it off. So first question, am I invested in the S&P 500 as a client of AWM?
Absolutely. The S&P 500 is a very important part of your portfolio. It's a big segment of the portfolio. I think one thing that people forget is, what is the S&P? The S&P is actually just a collection of companies, happens to be 500, hence the name the S&P 500, but it's actually the largest companies in the United States. We talk about this a lot with you guys. We want you globally allocated to every company virtually throughout the entire world. And so that does include, believe it or not, the 500 largest companies in the US. But we just don't want you to only be invested there. It's a common thing you're going to hear on CNBC or any of the financial news markets, and it is something that our industry uses to benchmark things. However, when you're taking a more sophisticated approach like you guys are with your portfolio, your opportunity extends far beyond that. But yes, the answer is yes, you do have access, or you are allocated to those 500 companies. I think a good example of that is NVIDIA. We've seen that kind of skyrocket this year. It had a little down trough, but then it skyrocketed, even in the midst of all this tariff talk. It continues to go up. But the question is, do I own NVIDIA? Yes, you do. In fact, your portfolio is allocated about a little over 5% to NVIDIA. So you are participating in that growth, even though you're allocated to many areas of the market. So hopefully that's helpful to you guys. Another question, Mena, we've gotten throughout the week is, why do we buy into the market? Why do we want this globally allocated portfolio to companies instead of going after the, hey, kick the dirt, actually have the real estate, go all real estate or all gold, for instance. I'll stay away from that one because I'm too opinionated, but give our audience the answer to that from our perspective.
Yeah, and actually there's been a meme going around about gold and real estate and the growth over a 50-year period of time, where $64,000 of gold or real estate that you could have used back then to buy a house would be worth the same amount, approximately $1.3 million. That sounds great. That's a 20x on your money. But over 50 years, if you actually look at the growth rate, it's not incredible. It's only a 6% rate of return. If you actually look at an index of the entire global economy, the MSCI World Index, that $64,000, if you would have just invested it in that index and reinvested your dividends, and dividends are your passive income when you invest in the stock market, you would have not 1.3 million, but $12.4 million. So that's almost 200x on your money over a 50-year time frame. And that's the power of compounding, when you can move the amount of money that you're making and your return from 6% to just 11%. It's a 5% difference. It doesn't sound massive, but it's a 180 times difference from your starting value to your end value.
Yeah, and I think that's an important point. I think one thing that a lot of people lose is, what is investing in the first place, right? What are we expecting if I'm going to put my money into something? I'm going to go buy a block of gold, right? What am I expecting out of that block of gold? Well, maybe I can shave it off and go down and buy something. I don't know how you do that, but maybe you could do that. But when we actually go invest our money in the market, what are we buying? You hit on it, the dividends, right? So we're buying a company. We're buying a share of a publicly traded company. We used NVIDIA previously. When NVIDIA makes money, they charge clients money, they make revenue, they have all their costs, they have something called profit at the end of the day. You're buying a share in that profit. You are getting cash flow from that. So when we take a look at things and we can evaluate, hey, if I'm going to buy this, I'm expecting these cash flows back. We can figure out a price, or at least the market can figure out a price. I think that's the hard part with gold, right? Like, how do you figure out the utility of gold?
It's just whatever someone's willing to buy it at.
There you go.
Yeah.
There you go.
So yeah, just like you said, with the sophisticated portfolio, holding 10,000 companies that are working for you and making money for you is proven to be a surefire way of actually making money over time, no matter the market condition. Obviously, you're going to have your ups and downs, but over a long period of time, you can be more certain that you're going to make money. We always talk about the lost decade for the S&P specifically. That's why we don't focus on one asset class, but gold beyond, this last couple year period of time was flat for a pretty long chunk. So yeah, that's why diversification and investing globally really matters. Cool. Next question, where do you see interest rates moving and how will that impact markets? That is a loaded question. So yeah.
Hey, it's I got to be the guest today. So one thing I thought about doing was bringing my trusty crystal ball. If you listen to early episodes, I used to have the trusty crystal ball. I could predict the future. But no, all joking aside, I have no idea. I don't know that anybody has any idea of when interest rates are going to change. But what we probably can take a pretty good guess at is that over some period of time, interest rates are probably going down from here. We get indications of that from the market. There's ways of looking at that and seeing expectations from the market. You also get indications from the Federal Reserve time to time, although that's a kind of a tricky thing nowadays. But, trying to predict when is actually the key point. I think when you think about interest rates, the point that I would like to make and for everybody listening to understand is what does it actually mean when rates change? President Trump is being very vocal right now, his displeasure with Federal Chairman Jay Powell around not, cutting rates. We just had a new Fed member appointed. They're calling for Powell's head. So there's going to be a lot of changes here. What an interest rate cut, though, means is does not directly correlate to the loans that you have. I think that's one misunderstanding we often have is, hey, if we get a quarter point, so a 0.25% reduction, my mortgage is going to go down to 0.25%. Or when I go to get a new mortgage, it's going to be 0.25% lower. And while they're correlated, it is not directly linked in that way. And so there's a lot of different things that go into how the interest rates actually flow down to us. So I just, I caution you of, getting on one side or the other, really wanting a rate cut or not wanting a rate cut, because it may impact you differently. The other thing that often gets forgotten is that, rates do have an impact on the equity markets. It is one of the building blocks of our expected returns is the risk-free rate. And so it's a very complex situation when we have rates change. That being said, we do protect your guys' portfolios with an expectation of where rates are going to go. So it is something that we're acutely aware of, and we're making sure that, we're making the adjustments necessary in your portfolio to protect you against that. Do you have something you want to add to the interest rate?
Honestly, it is extremely complicated. Like you highlighted, it moves asset prices like equity markets. It moves borrowing costs, which you can think about like if money's cheaper, probably more economic activity will happen. But on the flip side, when you actually reduce rates in the US, you're also technically impacting your currency in a negative way. And you highlighted it. We protect our portfolios and invest them, in a way where they should be able to perform well given interest rate cuts or hikes. That's where I think the international piece really comes into play. because even if the dollar goes down, which it has this year, our clients can still make money in international and emerging markets, no matter how currencies move or interest rates move. So yeah, it's about being prepared and building a boat that doesn't have any holes in it.
I think that's super helpful. And you kind of, teed this one up for me. It's a conversation I'm having a lot right now with clients, because it's a good time to remind them of why we're invested globally. It's pretty natural for us to want to invest in the US. I mean, when you start to take a step back and you're like, hey, the US, great performer over a long time. We talk about this a lot. One of the greatest wealth building machines has been the US economy over the last 150 years. But it's also a really good time, even when the US market has been really good, to take a step back and go, hey, in a really good market, has it benefited us to be a part of the international markets? And so, Mena, I'd love for you to hit on a little bit. Why do we continue to invest internationally? And especially with all this tariff news is out there, tariffs, well, I won't give you the leading question, but I think the perception is tariffs are very negative for the international markets. But I would love to hear your perspective. How are we thinking about it and building the portfolio?
Yeah, and just from a surface level perspective, they should be bad for international emerging markets. But this year has sort of defied that for a bunch of reasons. If you actually look at performance, international emerging markets have outpaced our markets here, even though you would think that there would be pressure on them. That's because of the currency reasons. The dollar has been devalued. Our interest rates are expected to go down. Those two things actually operate together. And also the fact that, we are not the entire global economy. I'm a car guy, so I'm going to use BMW as an example. There's a 15% EU tariff. If you're buying a BMW here, when that tariff is in effect, it's going to be more expensive for sure. So less people are going to buy BMWs. That doesn't necessarily mean that BMW is not going to shift its strategy to sell more cars globally and still potentially make the same amount of money. So what the market right now is doing and pricing in is it's pricing in that the global economy is strong. These international markets are strong, and these companies that are selling products that are probably going to get hit in the US slightly are figuring it out and actually still making money in the other parts of the world where tariffs are not hitting them as much.
And I know you guys have talked a lot about tariffs, but let's not forget tariffs are ultimately a tax, right? And so when we think about the domestic versus the international conversation, there's an impact domestically as well. Apple is not going to eat the cost of the tariffs. Let's just call a spade a spade. Who's going to eat the cost of the tariffs? Everybody that buys one of these iPhones is going to eat the cost of the tariff. And we already see there's a lot of gamemanship going on. There was the 100%, the threat of 100% tariffs on chip manufacturers right now. And then Apple says, no, we'll open a manufacturing facility and dump 100 billion in. It's like, okay, now you're excluded from the tariffs. So, I just hesitate to or I caution everybody again, there's a lot of news flying around out there. I think the thing for you guys to take away is we're paying attention, but also we're allocating your portfolio in a way that is going to withstand any short-term disruptions that we see, because we're building for multiple generations. You guys are trying to build generational wealth, and we know in the short term, we're going to have peaks and valleys. That is just part of it, and that's why we get rewarded as investors. But we're really keeping a keen eye on what the long-term trajectory of your portfolio looks like. So, this has been a lot of fun. I'm glad I got to come back and make a little bit of a guest appearance. I'm sure they'll kick me out next week. But make sure to shoot Mena some messages. We'd love to hear your feedback. I think he's even going to let you reach out to him directly.
Yeah, text me directly.
Questions.
Text me directly, please. Always here to help. And you can actually set our agenda for a future Insights episode, and we can talk about what matters most to you. So my number, direct line, 626-862-0355. Feel free to text me, and yeah.
Yeah, and if you want to be a guest, come on in. We'll put you in the pod here. We'll record an episode with you, or we'll get you on the line somehow. We'll figure that tech out. But We hope you have a great week. Hopefully this was helpful. We appreciate you more than you know. And yeah, own your wealth, make an impact, always be a pro.